Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Thinkorswim. And today we're going to be talking about 5 tools that are available right there on Thinkorswim charts that might assist a trader in spotting stock price highs and lows, those areas of price floors and price ceilings that sometimes referred to as support and resistance. Should be an interesting discussion. A lot to cover, but before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I always keep an eye on those chats. I like to see those familiar names. Always nice to see somebody new, but hello there, Josh and Kevin, Ricebird, Life in the Fast Lane, Ketline, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, though, I want to welcome you as well. And if you're joining or watching the webcast after the live stream is concluded, if you're just watching the recording, that's a great way to watch these webcasts. You're certainly invited to join us in the live stream in this audience. If you'd like to be here, this is a Wednesday webcast series, and we kick things off promptly at 2 Eastern Time each Wednesday. Now, I also want to let you know that you can follow me on social media. You can find and follow your favorite Schwab presenters on social media. I would strongly encourage you to do that. It's the place to connect with us in between the live streams. You can find me on X at Cameron May CS. You can pop over to linkedin.com/in/Cameron May CS. And if you reply to my posts on either of those platforms, I just try to reply right back to you. But let's get into this discussion. This is going to be an interesting one. We're talking about 5 tools that might assist in identifying highs and lows on a stock chart. So as we do this, of course, we want to bear in mind the risks associated with trading or investing. Risk is real, so keep this stuff top of mind. All corporate or issuer names and market data shown are for illustrative purposes only and not a recommendation, offer to sell, or a solicitation of an offer to buy any security. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risk, including a loss of principal. All right, so with that important stuff accomplished, let's set the agenda for today's discussion. It's all about identifying stock highs and lows today. We're looking for support and resistance. What are some tools that a trader might recruit in those efforts? So I want to talk through 5 tools that might be used. I'm not saying they all need to be used in combination. It's not a promotion to use any of them even individually. But what I want to explore is looking through the lens of a trader, trying to identify price highs and price lows in their efforts to do shorter term trading. These 5 tools. We're going to look at one that can be applied manually directly to a price chart. It's a drawing tool. Now, then we're going to look at 2 different technical tools that can be applied automatically. They're known as technical studies. They can just be applied automatically to a chart. And finally, we're going to wrap it up with a review of two final tools. Tools number 4 and 5 are going to appear on the chart, but as a separate study below the price chart. Should be interesting. Let's get right into it. And oh, by the way, I should also mention, I mentioned that you should be following your favorite Schwab presenters on social media. I certainly would encourage you to follow Barb Armstrong, who's also joining us in the chats. Thanks for helping me out there, Barb. But you can find and follow Barb on X at Barb Armstrong CS. But let's get into this discussion. Let's go right to the Thinkorswim platform. And today, we're going to be demonstrating each of these 5 tools using a 1-year chart of Eli Lilly. Now, it doesn't have to be Eli Lilly, obviously, and it doesn't have to be a 1-year chart. These same tools can be applied on different time frames. But we'll stick with the daily charts just for today's demonstration. But let's kick things off with a tool that's sometimes used by traders who prefer to use their own discretion in identifying price floors and price ceilings. And we're going to start it with a tool known as a Fibonacci retracement tool. Now, this is a tool that automatically draws support and resistance lines, but it depends on the trader's discretion, the positioning of the tool. So I'm going to apply the tool. We'll do a quick recap of how it's built. Then we'll talk about how it might generate trade signals. Then we'll move on to tool number 2. But this is actually found in our drawing tools down here in the lower right. Right now, my active tool is an arrow tool. I'm going to click on that, and I'm going to select from our menu of tools here, the one that looks like a big percentage icon. Fibonacci retracements is the tool that we're going to be using. Now, I'm going to give you a cursory introduction to this tool. If you'd like a deeper exploration of how the tool is explicitly built, and then additional examples of how it might be used to generate entry and exit signals, let me make a recommendation for you, especially if you're new to our channel. And that is, make sure that you're subscribed to our Trader Talks channel on YouTube. Just pop down below the video stream right now, click on the subscribe button. It only takes a second to subscribe. It doesn't cost anything to do that. But our YouTube channel is where you can find other videos like this one that address a whole range of trading and investing topics. And included among those are several videos that I've done where I've spent an entire 45 minutes going deeply into the construction and the application of Fibonacci retracement lines. So here we are on the Trader Talk Schwab Coaching Webcast homepage on YouTube. You can join our live streams right here on the homepage. You can find playlists of previous webcasts, but what I wanted to highlight right now is that you can do a quick keyword search among all of our archives across the whole range of different webcast series that we have. Zero in on something that might be of particular interest to you. So for example, we're talking about Fibonacci's right now. So I'm going to type in the word Fibonacci. That's Fibo and then one N and two C's, Fibonacci, and hit enter on my keyboard. And here's a webcast where we talked about how to use 5 different Fibonacci tools, not these 5 support and resistance tools that we're talking about today, but there are actually 5 that are just specifically Fibonacci tools. But the one that I would probably suggest that you start with, if you've never heard of Fibonacci's before, is this right here, Beginner's Guide to Using Fibonacci's to Trade Stocks. And you can see that was a 42-minute video. We explain how these things are built, but going back here, let's apply a Fibonacci, and I have something to help me out. Before the webcast started, for each of our examples today, I've made some drawings on the chart. So we're going to load up our LLY fibs. Fibonacci's are commonly referred to as fibs. And what you'll see are these pairings of 2 arrows, one up, one down. And really all those are doing are identifying areas where Eli Lilly has gone for a particularly strong move in a particularly short period of time. And that's a typical time when this tool is recruited. When there's a strong move up in a bullish stock or a strong move down in a bearish stock, then the trader might use this drawing tool to identify potential price floors and price ceilings. So how about we use, let's just go back to this first one right here. Big strong move up back September into October of last year. And I've selected my Fibonacci retracements tool. And the way to draw these is to go to the top of the move and click once, and then go to the bottom of the move and click again. It's not a click and drag, but 2 separate clicks. Notice my hands are not on my mouse right now, so it's not a drag. It's 2 separate clicks. But as we do that, we're presented with a whole series of lines. And those lines have associated values. 261.8, 161.8, 100, 78.6, 61.8, and so on. So where do these values come from? Well, we actually borrowed these from mathematics. They're generated from something known as the Fibonacci sequence of numbers. And additionally, there's a ratio of those numbers. There are potentially important ratios of those numbers that are used in mathematics, and trading has just borrowed that. So if you want to go see exactly the Fibonacci sequence, if you want to see those ratios being demonstrated, go watch that video that I mentioned. But let's talk about the application. I'm going to zoom in here a little bit. Let's zoom in maybe on this time frame right here. It's going to give us a closer look at these numbers. And I just want to get into the psychology of what the trader's attempting to do here by applying these Fibonacci's. What we do know is that with the benefit of hindsight, so putting ourselves in the shoes of a trader who maybe saw the stock starting to pull back here in the second week of October, is there was this really strong run up. That is comparatively stronger than it has been in the past. And if we want to put that in real numbers, or than it typically has been in the past, this stock went from $712 up to a high of $864 in about 2 weeks. All right, that is a big, strong move in percentage terms. So we have this racing up of stock price, and when a trader sees that, they think there may be a reactionary move to that. So A lot of people just made a lot of money in a short period of time. Maybe some of those will start taking profits, drive that price back down for a period. So there's something exciting going on, but the trader's trying to avoid buying it at the peak of excitement. Instead, they're waiting for some others to blow off some steam, to take some profits, and maybe the stock, once those profits have been taken, maybe it'll get a little bit of a tailwind and start running up again. That's the theory of this kind of trading. That's what we're looking for. Well, it can be difficult to spot those price floors and price ceilings in the middle of these dramatic moves. So this tool sort of slices up the move and then shows us potential areas where we might get a reversal. And a common reversal assumption here is that when there's a strong move to the upside, the stock might give back about 1/3 to about 1/2 of that move as those presumed profits are taken. So in this case, that would have us pull back to somewhere between the 61.8, approximately 1/3 of that 100% move to the upside, meaning from this low to that high, there's our move. Basically starting at 0 going up to 100, if you can envision that. Anyway, but we pull back to somewhere between 1/2 and 1/3, and this is a common entry for a Fibonacci trader, with price just getting down into that range. So when might they exit? Well, some may take profits if profits arise. They might take profits if we get back up to just the high that was previously achieved. In this case, that might be going from maybe $790 up to $865. This looks like a little tiny move. That was actually a 75-point move, basically a 10% move, again, in just a few days. Or they might look for a continuation of that enthusiasm, matching the original move. So they might look for the stock not just to get back up to the peak where the profit taking started, but maybe match the original move and taking us up to what's called the 161.8 level, which is basically just taking an assumed retracement down to the 61.8 level, and then a 100% move upward, or a percent, let me just say, a move matching the original move from that level. That's how we come up with that 161.8. So in this case, some more conservative traders might have taken profits here. Others might have waited to reach back up to that 161.8, or maybe they took half here and the rest here. Lots of different ways that this might be traded, but it doesn't always work. Sometimes it fails. So the trader might look for, if we get down below 50, and especially if we slip down below that 38.2, maybe this one's not going to work out so well. Maybe it's not just profit taking. Could it be that there's some panic selling that's crept into the equation? Yep. In that case, maybe the trader just takes their lumps somewhere down in that range. So that's a typical or a common application of this tool to identify price highs and price lows, and then to trade those. So if we zoom back out, we can see that there have been a few more of these. It's interesting. Here was the projection to the 161.8 level. We reached that. We actually got up another equivalent move to the 261.8 and then started chopping sideways. But even into the distant future, these levels may identify potential price floors and price ceilings. For example, as we got above this 261.8, that seemed to have acted as a pretty good price floor. So let me remove that. Let's get a little bit of repetition with it. Then we're going to move on to our second tool. All right. Here's another big move to the upside. We'll go to the top, click at the top. Oops, I've actually switched my tool. Let me remove this drawing. And we'll switch this back to the retracement line. So here's a big move to the upside. Click at the top to start the drawing. Click at the bottom to end the drawing. We're looking for a retracement somewhere between 61.8 for entry. Maybe taking profits here, or waiting. It's interesting, where we touched just recently. Right up there. All right. So those are your Fibonacci tools. That's the first of our 5 tools we're exploring today. But this one certainly requires some trader's discretion. Notice that everything springs from where the trader decides to make their drawing. So our second tool, let's remove this one. Let me go back to our default drawing set. Nice clean chart. Our second tool is going to be a technical study that's just applied automatically to the chart without even any customizations. No discretion required aside from selecting it as the preferred study. So I'm going to come up here and let's talk about Bollinger Bands for just a moment. Another study that's commonly used by traders who are maybe struggling to identify price floors and price ceilings, price highs and price lows. Let's choose Bollinger Bands. Let's click Add Selected and click Apply. Now, if you're not familiar with the Bollinger Band, it consists of 3 lines. We have, first of all, our center line. That's sort of a key line here. And what that is, if we look up here next to the words Bollinger Bands, you'll notice it says close. This uses closing values in the construction of this indicator. It says 20, which means that it's looking at 20 days worth of trading data and then generating a 20-period simple moving average or a 20-period trend line. That's that green line. It's just showing us how average prices are changing on a rolling 20-day period from day to day. That's what that green line is. And some traders will use that for potential areas of support and resistance, highs and lows. They might also use it for trend identification. But today, I want to talk about using it for trading. All right. So that's the green line. Now, above and below that line at prescribed distances is a red line and a purple line. That's sometimes referred to as an envelope or bands in this case. So how are these bands generated? Well, you notice as we look back up here next to the green words Bollinger Band, it says -2 and then +2. So in this case, what it's doing is it's using something, again, from mathematics. Actually, we might say from statistics. This is known as a standard deviation. And what a standard deviation attempts to do is, first of all, we determine what normal is supposed to be. And the assumption for the trader here is that normal is this 20-period simple moving average. Right or wrong, for better or for worse, that's the assumption. If this is average prices over the last 20 days, well, if the current price is getting really high, whatever really means, or really low, whatever really means, maybe it's reaching highs and or lows, right? So these 2 standard deviations attempt to define extreme highs and lows. So what's a standard deviation? Well, it's a departure from normal. In this case, our simple moving average. If our stock goes down lower than it has been on average in the last 20 days, how low might it go before starting to reverse? Where can we spot those lows? And with a standard deviation, it's just a mathematical formula that says, well, we're going to try to capture 95% of all trading activity. So where would we draw this lower line to try to capture 95%, make sure that basically 95% of all trading is happening between the upper band and the lower band. That's a simplification of a standard deviation, but there we go. So if price reaches that lower band, what it's basically saying is, this only gets down here about 2.5% of the time. There's 5% of the time where we're trading outside of this band. So only 2.5% of the time are we below the lower band, 2.5% of the time above the upper band. So those might be defined as extreme highs or lows, and a trader might trade on that information. So if we've reached an extreme low, maybe they buy. If we reach an extreme high, maybe they sell. All right. So let me apply a new drawing set here just to illustrate this. Let's get up our Eli Lilly Bollinger Bands. And just looking at recent examples, here's average price. Each candle represents that day's actual price. And just a couple of weeks ago, maybe 3 weeks ago, we got pretty low. We got down to that lower 2 standard deviation band. And for some traders, they might recognize, wow, this is about as far as we typically get before prices start to move back to normal. There may be a reversion to the mean at this point. That just means going back to normal. So price, in this case, that worked out. price started to rally. So our entry looked like that was valid. And again, just in this example, it doesn't always work. Well, where do we take exits? Well, if we're trying to buy at extreme lows, maybe we wait to sell at short-term extreme highs. So a common approach is to buy at the lower band, sell at the higher band. Sometimes it works, doesn't always. Another approach is to just look to buy at average prices as defined by our 20-period simple moving average, and then sell at that upper band. A couple of different ways. Now, neither of these are guaranteed, so having a defined exit, maybe if we're entering on that lower band, if the stock continues to go down, maybe we just exit if it continues to fall. Or if we're entering on this middle band, maybe exiting if it continues to push toward the lower band. All right, so that is known as the Bollinger Band. And it's another technical tool. This one, again, doesn't require trader discretion other than selecting that as our study. It's just automatically applied to the chart. It is customizable, but I'm not going to make those customizations today. So let's move on to our third study, which is another tool that can be applied directly to the stock chart. But as I do that, I've noticed there is a survey today. That's excellent. Barb has already reposted it, which is appreciated. But guys, if you're here in the live stream audience, do me a favor, click on that survey link that's there in the chat window. And if you can just take time after the webcast is over then and fill that survey out, it's never a wasted effort. I always take the time to read through that survey data. I read through your comments. Our surveys are really short, just two quick questions, and then a comments box and a suggestion box. But if you take time to fill it out, I'll read it. It always helps. All right, thank you. And thanks, Barb, for reposting. But let's get on to our fifth chart tool for spotting price highs and lows on a stock chart. And that is, let me just clean this up. First of all, I'm going to switch back here to our default drawing set, clean it all up. Let's remove our Bollinger Bands. Click Apply and click OK. And then I'm going to add something known as a linear regression channel. Sounds like a mouthful. It's actually a fairly straightforward tool. Before I do it, though, what we're going to wind up seeing is three parallel lines on the chart. We need to understand the first line. The linear regression tool, again, attempts to define normal. But instead of just moving back and forth with a 20-period simple moving average, it by default just draws a line right through the center of the chart. It's going to look something like this. Like if I were to give you an assignment to draw a line through the center of the chart, you're probably not going to draw it up here. You're probably not going to draw it down that way. It's probably going to be an upward sloping line, kind of splitting right through the middle of all the candles. Well, that's all this does. It finds sort of the center point of all the trading for the time frame of the chart, and then it draws two other lines. So let's do this. Actually, we're going to wind up with 5 lines total. So I'm going to remove my line here. And let's go up and choose our two studies. Linear regression. Linear just referring to line. And then regression meaning potentially a regression to that center line if price gets away from it. So let's choose the linear regression channel 100. And we're going to choose the linear regression channel 50 and add those to our charts. So here are the 3 lines, and you'll notice the center one. Doesn't that look an awful lot like the one that I just drew? It's simply a line splitting through the middle of all the trading. And what we're looking for here, if this is normal, where do we see extreme moves away from normal, and might there be a regression back to normal, as defined by that center line, if we get a big departure? So how do we define a big move away from normal? Well, literally, the chart just looks at where did the stock itself actually get the furthest from normal. So you'll notice right here, see that right there? That's the furthest away the stock price has been all year long from this center line. So that becomes our definition of extreme. It is the 100% departure. So we just draw a line right through that. Then we draw another line that's exactly equally distant to the upside. So this is our linear regression channel 100 that's a negative 100. This is our linear regression channel that's a positive 100. And then we just split the difference with our linear regression 50. In other words, it's 50% of that big distance move. And these now become potential areas of support and resistance, potential price floors and price ceilings that traders will sometimes trade. All right, so let's do this. Let me remove this little drawing. I'm going to add the linear regression channel drawings that I've added, and let's talk about how this might be traded. Well, sometimes the trader will look for a bounce off of one of these channel lines. So this green line here, notice we got down to that line and we started to move up. A touch or a move off of one of those lines can become an entry. So if we're trading entering on one line, the exit is typically just if we reach the next one. So here's another one where we came down, we touched the 50 line, that's an entry. Touching the linear regression line, the trend line, that could be an exit. Sometimes it's a touch where we're coming down and we touch that line. Other times we're just coming up and through a line. So a breakthrough of that line, like we got right here. This one's a little bit splitting hairs, but price was below our trend line. We moved up and through that. That can also be a potential signal with an exit if we get up to the next line. Then back and forth the trader might go. Now, obviously, it doesn't always work. So the trader might want to have a plan that if we enter, let's say we got in on this green candle, and instead we came back down below the green, started headed toward that lower red, maybe we exit there. So this is the linear regression channel tool. And what I've done is done a combination of these. We could have used just the 50, that's the green. We could have used just the 100, which would be the two red lines. Those don't generate signals very often. Just so you know, if that's the habit, you have to be patient. It's going to be a pretty long span between signals on those. But there's a quick introduction to the linear regression tool. And if you want to see this one in greater detail, if you feel like, man, Cameron, that was a lot to absorb in a short period of time, I'd like to see more of this. What can you do? Well, make sure you go to our Trader Talks channel, make sure you're subscribed, and then just click on the little search icon here and look for linear. I'll just type in linear, and what do you know? There's a discussion combining 3 linear regression line tools into one trading strategy where we spent the entire 42.5 minutes again. That's interesting, 42.5 minutes, just like the last one, going deeply into that tool. That's tool number 2. So we've looked at a drawing tool that might be used by a trader to apply their own discretion. We've looked at 2 price chart tools that can be applied automatically. Notice I didn't make any customizations to these tools. I just applied them to the chart. Well, there are some tools that are actually not applied direct to the price chart, but they actually appear as a separate technical tool or study below the chart. So let's do those. I'm going to do 2 of those. Let's clear these regression channels off. And let's go back to our default drawing tool. So we have a nice clean chart of Eli Lilly again. And the first lower study that I wanted to explore is a momentum oscillator. Both of these are going to fall into the category of what are commonly referred to as oscillator indicators. An oscillator is just an indicator that's always going sideways, but up and down. And what it's doing is it's searching for highs and lows on a stock chart. So a typical indicator or a typical entry signal from an oscillator is if it reaches an extreme low and starts to go up. Or if it reaches an extreme high and starts to go down, that might be a bearish signal. Maybe it's a signal to exit a bullish trade. But the first one I'm going to apply is kind of shorter term in nature. The second one is going to be a little longer term, maybe intermediate to longer term. So the first one is going to be our MACD histogram tool. So let me choose the MACD histogram. Let's add that to our chart. And this one, it's a little bit involved. The 12-26-9 is our default. Those are 12 days, 26 days, and 9 days if we're looking at a daily chart. Is looking at the interaction of 2 trend lines over a 12 and a 26-day period. and the average distance of those lines smoothed over 9 days. Ooh, that's a lot. But whether you follow the logic of the construction or not, and by the way, if you want to see this one explained in more detail, you can go check the archives. I've done it before. Let me just click OK. And what you'll see here is this oscillation. Oscillating, the word oscillation just means going up and down. Matter of fact, there's a kind of old-timey scientific tool known as oscilloscope. I don't know if you've ever seen this. It literally just goes up and down like this on the display. Kind of cool to look at. But as we're oscillating up and down, for some traders, this might mean we're getting shifts in trading momentum between buyers and sellers. So when the oscillator is heading downward, the typical interpretation is that the sellers are kind of in control. There's more selling than buying going on. Maybe we're headed down toward a price floor. Now, if the sellers start to lose their grip and the buyers take control, the momentum might shift, and that might signal that we're at a price floor, maybe going to move up to a price ceiling, and vice versa. So if our oscillator's high and it starts to slip and go down, maybe we're at that ceiling, possibly moving back down to a floor. So what are the trade signals? Let's add that to our drawing chart, to our chart. Here's our LLY MACD histogram. One common entry is to look for those low dips in our momentum oscillator, and there's a bit of a visual cue here. As the oscillator is going further down, we get these bright red histogram bars. If those histogram bars get shorter, in other words, we're starting to tilt up, we'll see a change in the color scheme from bright red to dark red. My word for that is it's a red shift. And that might be a signal for a trader that bearish momentum on our stock has started to shift to a bullish tendency, and maybe it's going up to a new price high. So in this case, there's an entry. There's another one right here. We might have had to be patient, a little bit of a whipsaw for a couple of days. And in this case, it never got to, let's say, an exit signal. What's an exit signal? Well, an exit signal is if we get green histogram bars that then shift to a dark green. So here's bright red to dark red, entry, bright green to dark green, exit, right there. Here we got a couple of entries with no exit signal in between, but finally, there's an exit signal right there. So if that helps you to spot those signals, that would be a typical application of this indicator. Once again, no indicator is perfect. So even if we think we've spotted a low and we think we're on our way up to a high, sometimes it just goes down to lower lows. So what might be the exit here? Well, upon entry, the trader might look back to recent lows, and if price goes below those, maybe they just pull the plug. So an example here, there's our entry. Recent low was about right here. So if we start to stretch below that, might be time to take our exits. Bogus Chinchilla says, and I'm glad you asked because I knew it would come up and I need to address it. Where are you getting the red and green arrows? So all I did was I used our little arrow drawing tool here. It's right there. Clicked, that creates an arrow. It might be a little black arrow by default, but you can change the color and the orientation, up, right, up, down, left, right. You can just right click on any arrow we've drawn and edit its properties. So we can change the direction or we can change the color. That's what I did. Change direction and color just to make it easier for my audience to see these trade signals that I'm talking about. All right, so there is tool number 4 that might assist with identifying price floors and price ceilings, highs and lows on a stock chart. So we're going to do one more. It's going to be a little bit longer term. That's its typical trading outlook. And this one is proprietary to Thinkorswim. You can't find it anywhere else, so that probably gives it away. It's the market forecast tool. So I'm going to come up here. Let's actually, first of all, go back to our default drawing tool set so it's nice and clean. Let me go up to my little flask icon and remove the MACD, but replace it with the market forecast. It's right there, market forecast. Let's add that to our chart and click apply, click OK. Market forecast can be kind of a complicated tool when we first see it. It's basically three what we call stochastic oscillators, but again, notice they're oscillating up and down, but overall going sideways. And these stochastic indicators are of three different time frames. We have the red one, which is known as the momentum line, very short term. It oscillates very rapidly. We have the blue near-term line, oscillates a little bit less rapidly. And then finally, we have the green intermediate line, which is the slowest to change direction and can take a while to get from what we'd call an overbought area when it's high on this tool to an oversold condition, which is very low on this tool. So this is among those oscillating tools where instead of looking for color changes, we're looking for values. And specifically, this indicator is built on a range of 0 to 100. And if one of these oscillators gets below 20, it's considered to be an indication of an oversold condition possibly on the stock price over three different time frames. If it's above 80, that may be an overbought condition. So let me throw on my drawing set for this tool just to help you out. And again, so what you're going to see here is those arrows that I've drawn before on our other charts, but also you're going to see two horizontal lines just to help us zero in on 20 and on 80. So here we go. Let's add market forecast line. Oh, I might need to squish this down. We can't even quite see our green arrows. You see those there? They're kind of obscured. I can come over here to the right and just click and drag that down a little bit. There we go. Make those a little bit easier to see. I've had to compress that indicator a little bit. But notice that I have drawn these lines at 80 and at 20. So when these oscillators poke down below 80, which the red line does very frequently, the blue line does less frequently, and the green line doesn't do it very often at all, that may indicate that stock prices are getting to or near low levels, right? And specifically, let's talk about trade signals. You notice I have three green arrows here. Those are three specific trade signals, possibly the most commonly used, but not a common trade signal at all on this indicator. It's known as a cluster. That's when our three lines get below 20 literally on the same day. So if I point at this green arrow, you can see if we look up here, these are the numerical values for our three lines, red, blue, and green. And if I point at one of these, you'll notice red, 2.5, green, 3.8. Pardon me, blue, 3.8, green, 4.4. All of those values are below 20. All of our oscillators are reaching extreme lows at the same time. And for some technical traders, what that might imply is that if we're all bottoming out at the same time, maybe there's nowhere to go but up. Yes, the stock can still go lower. As a matter of fact, it did right here. But you'll notice in the entire last 12 months, there's only been 3 clusters, and they actually all happened in fairly rapid fire succession right here. And each of those did a not terrible job of identifying price pretty close to floors rather than being closer to ceilings. So yeah, whether the entry was taken here or here or here, none of those was terribly far from what turned out to be the ultimate bottom. And as a matter of fact, this one kind of nailed it. So those might be taken as an entry. Now with these, they don't happen very often. The assumption by the trader is that there may be a lot of upside potential. So typically, a stop, if used, is placed a little more distantly below the entry. So, so we might look at placing a stop. You know, it might be several days worth of trading below that entry. But in any case, there's our entries. Where might profits be taken? Well, a typical exit, you'll notice right here is a red arrow, and that coincides with this day. When we get our entry, our focus shifts to just the green line. So let me do this. Let me come up here. I'm gonna thicken that green line. We can actually edit that study. Let's click on the little gear icon here. I'm gonna go to that intermediate green line. Let's make it a 3 out of 5, so it kind of stands out. 3 out of 5 in thickness. Click OK and click Apply. Kind of stands out there. A little bit easier. MBH says Mike has a scan for the market forecast tool. Yeah, that's fantastic. Mike does a great job with his scans. I also have a scan for the market forecast tool you might want to check out. But in any case, there's our entry, or this one or this one. But in any of those entries, we might be looking for that green line to get up above 80. Now we're up into the oversold, oh, pardon me, the overbought area. And if it starts to fade below 80, there's our exit. So that's where we would identify this. So our entry might have been here, here, or here, with an exit up there. So guys, those are 5 technical tools that might be used to help identify price floors and price ceilings, price lows or highs. Yep, we call it support and resistance. And this is not intended to be a promotion of any of those. What I do want to do is just help the trader to fill out their toolbox, and they can just decide for themselves which technical tools might be used in their approach, if any. All right. Ricebird, hey, you like that review? Kevin, very much my pleasure. Time for me to let you go. We've accomplished what I set out to do today. So let me give you one final reminder. If you haven't subscribed to our channel yet, do that right now before we wrap things up. Or if you're watching on the archive, just pop down below, click on the subscribe button. But also make sure that you're following us on social media. Follow your favorite Schwab presenters on X or on LinkedIn. So you can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts here, I just try to reply right back to you. It opens up those channels of communication when the camera's not on. Now, or you can pop over to linkedin.com/in and then /Cameron May CS again. So my handle on both platforms is Cameron May CS. But here we are on LinkedIn, Cameron May CS. Give me a follow here. And if you reply to my posts with a comment on LinkedIn, I just try to reply right back to you. That's how you reach me in between. Let's see. 2 Continents, 1 Island says, could someone share the market forecast scan or point out where it can be found? Well, yes, we actually have a moment. Let's go to our YouTube channel. And if I type in market forecast here, let's see. I'm just going to scroll down through. Oh, there we go. This one. Finding and trading signals from the market forecast tool. Check that one out. I demonstrated a scan in that video, and I think I even shared the link in the video description. I can't quite remember, but check that one out. Guys, thanks for giving me your time today. Definitely appreciate it. Thanks for all the thumbs up. There are over 100 people watching the live stream right now. And as I refresh the browser window, I can see that there are 36 that have already clicked that thumbs up button. That's always appreciated. When you watch one of our webcasts, if you enjoyed it, make sure that you always click that thumbs up, because it's always a pat on the back to your presenter, which is appreciated. But it also helps my videos find a wider audience out there in YouTube. It sends a signal to the YouTube algorithm. This was good stuff. Show it to other people, and the algorithm obeys. So thanks for doing that for me. Barb, thanks for helping out in chat. One final appeal to please fill out the survey. If you take a moment to fill out our very short survey, if you leave some comments, leave some suggestions, I read through all that data. I read through the comments and suggestions, and it always helps. So I will see you in a future webcast. I'll also look for you on social media, on X and LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.